Hey guys, it's Nick with Montgomery Financial Services here with your Q2 coaching class for 2024. Today we're going to talk about politics, specifically how elections can potentially affect your portfolio and exactly how to prepare for that as an investor. Now, while predicting which candidate will win the next presidential election is a little like forecasting the weather, one thing is for sure, elections tend to shake things up for a little while at least. And of course, we're going over this topic because if you didn't know, we have a presidential election coming up here at the end of the year, and we have had quite a few folks calling in asking what our opinion is on this and how it affects them from both an immediate term and a long-term perspective as it pertains to your financial portfolio. Now look, I understand that politics can be sort of a divisive topic, especially considering the election that we have lined up for this year with our two potential candidates. But my goal is, as always, to stay apolitical during our discussion here and respect the opinion of all of our clients who may fall on either side of the aisle. And interestingly enough, I am not the only one who stays apolitical during times like we are about to have, but it will be a common theme throughout this presentation that the market is actually also somewhat indifferent when it comes to who sits in the Oval Office. So sit back, relax, and let's jump right into it, guys. So as we get started here, there are a few key points that we are going to cover as we go through our discussion today. Starting with number one, which is the fact that political division in our country dates back to the time of the founding fathers who were truly the architects of our country, meaning that the current climate and divide that we see is really nothing new, right? Now, if you know anything about me, you probably know that I am a huge history guy, so prepare yourselves as I bore you with a few minutes of a quick lesson in history and the division that has sort of, again, always existed in our great country here. And we are going to take you back to just after the conclusion of the American Revolution, after the 13 colonies won their independence from the British colonial empire, and we established ourselves as a nation. Of course, everyone remembers the major document that truly founded our country, which is, of course, the Declaration of Independence, ratified on July 4th, 1776. But we are actually going to look at the document that followed, which really set the framework of our country, and that, of course, is the Constitution of the United States. This document was ratified during the summer of 1787 in Philadelphia, Pennsylvania, by 55 delegates that together made up what was called the Constitutional Convention. That constitution, or this constitution, was highly debated and controversial, and ultimately the document that we know today was the end result of political compromise, which included many different subjects such as states' rights, the separation of powers in our government, representation, and then finally slavery. And let us not forget that this was all accomplished in a small room with no air conditioning in the middle of summer by folks who, as you can see from this photo here, or this picture rather here, were well overdressed. But in summary, the Constitutional Convention is really when political factions began to form as debates took place over those various topics, as we previously discussed. And the friction between these factions increased as the attention shifted from the creation of a new federal government to the question of how powerful should that government exactly be. And back then, there were no Democrats or Republicans. Instead, we had the anti-federalists who opposed the Constitution and the Federalists who supported it. And again, my quick history lesson here was just to say that this is nothing new. Americans have always had their disagreements and differences. And honestly, while some folks may think that the political divide is more pronounced now more than it ever has been, a lot of historians, as well as myself, would point out to the years before the Civil War where the divide was truly the highest, in our nation. And let's not forget that there was a full-scale and open war over political differences during the Civil War, which was almost 160 years ago. But in conclusion, we here at Montgomery Financial focus on providing solutions that work for all families to fulfill what's most important to them, no matter personal or political beliefs. And while many people have strong political opinions, we will see here in a few moments, actually, that it has little correlation with the markets. Which is a good segue, actually, into my second of 3 points, which is that historically, political parties and politics have very little correlation with long-term investing results. So next, let's focus on market returns in election years. And I would start off by saying that ultimately it is difficult to identify a systematic return pattern in election years. And on average, market returns have been positive in both election years and then the subsequent following years. Lastly, I would argue that market expectations associated with election outcomes are already factored into the price of most securities or equities or stocks, rather. And as we take a closer look at this, we can see that the overall returns during and after an election year, you can see that the average returns during an election year are roughly 11.57%, and the average return following an election year is 10.67%. And this chart here goes all the way back to 1928 through our last election in 2020, which is pretty remarkable data, right, to look at this through history. And interestingly enough, this does not just pertain to the stock market, it also is reflected in our bond markets. You can see here that the average return during an election year in the bond markets was 6.84%, and the average return in the year subsequent to an election was 7.33%. This chart just goes back to 1976 all the way to today. And hopefully that can put your mind at ease if you are worried about the negative impacts on the markets sometimes associated with an election. But next, we can also see that the political affiliation of the president themselves has little correlation to market performance over the course of presidential terms. This chart shows the annualized returns during U.S. presidential terms, annualized returns during U.S. presidential terms, and it is broken down by Democrat and Republican, and you can see that ultimately the average return over either political faction there and over time is 10.28%. And you can really see there's only a few periods here where the entire presidential term resulted in a negative or flat return. This next chart here shows how if we again look internationally, you can see that political affiliation during presidential terms has little correlation with the market performance internationally. Okay? On average, international markets have returned about 8.48%. During all U.S. presidential terms since 1973. And again, this chart is broken down based on our political party. When we look further into emerging markets, they follow a similar trend at 8.92% since 1989. Now, these few charts are my favorite for a number of reasons. The first one being that you will see how ultimately, overall from a historical standpoint, markets have provided well for investors regardless of political affiliation. And as you can see from this chart here, the growth of the dollar invested in the S&P 500 dating all the way back to 1926 to December of this past year. A couple other things to point out to you here is that you can see from this it's very rare during a political term or a presidential term that results are negative when we look at the S&P 500, and it's also very unlikely that there would be a flat period as well. Of course, there are a few ups and downs with each presidency, but what I think is remarkable is that overall the trend on this chart, which I would argue is positive, meaning that the S&P 500 goes up regardless over time, regardless of blue or red. And let's not just focus on who sits in the White House. We also need to think about Congress, and you can see by this chart, this data here, that it is very much in line with everything that we have discussed so far, which is that while control of Congress is, of course, highly sought after or pursued by both political parties, it hardly has any correlation with market performance. Again, we see the growth of a dollar invested in the S&P 500 dating all the way back to 1926 and throughout, where there was both Republican, Democratic, and mixed controls of Congress. So hopefully I didn't just inundate you with statistics and data there with those charts, but the main message here I think is clear, which is that historically speaking, red or blue, the market doesn't necessarily care and our economy prevails over time. I would also argue that the political climate, we cannot let political climate dictate your portfolio decisions, as you would have a very small chance of positive results from doing so when we look at the long-term investing approach. Now, the last point that I want to discuss is that current economic circumstances may be unpredictable, but historically, markets recover and have in the past provided new opportunities for growth. And look, I understand that there's a lot of debate over our current economic conditions, and that these debates fuel some of those fires of division. Topics such as taxes and interest rates and our national debt are just to name a few. But I would propose that investors who stick with a long-term strategy have historically been rewarded. And again, I understand that some folks may be dealing with the direct results of some of these current economic conditions and issues. And ultimately, because of that, your confidence can maybe feel a little shaken. But I think the hottest topic up for debate here is, and that's on everyone's mind, and I imagine will also be a huge topic of discussion and debate amongst the presidential candidates, is inflation. And by definition, I'll throw this up here on the screen, inflation is an economic-wide sustained trend of increasing prices from one year to the next. And economic concept, the rate of inflation is important as it represents the rate at which the real value of investment is eroded and the loss in spending or purchasing power over time. Of course, since the coronavirus and the subsequent after effects, including some attempts to avoid a full-blown recession by injecting funds into the economy, we have been dealing with the steady rise in the cost of living, which puts additional financial stress on many, if not most, Americans. And based on most recent figures that have come out over the past few weeks, inflation is slightly on the rise. March numbers show us that inflation rose 3.5% compared to the 3.2% jump that we had in February, and core CPI readings had us at 3.8% on an annualized basis there. Almost half of these increases were, of course, from housing prices as well as gas prices. If we take a closer look at this on this next chart, you can see that the overall inflation over the past couple years clearly went up quite a bit after 2020 and then stayed somewhat steady into 2021 and 2022, but is now in a downward trend, and overall 2023 was relatively better than those previous 2 years. And as an investor, we may wonder whether or not returns will suffer because of inflation, but the good news is that I would argue inflation isn't always necessarily inherently bad for stocks or the market as a whole. By closely examining the performance of the market over the past 30 years, we do not see any reliable correlation between periods of high or low inflation and the stock market. If we take a closer look at this chart here, you can see that the performance of equities versus inflation since 1993, specifically the performance of the S&P 500 versus inflation, where you can see that there's an annualized return of 7.5%. On top of that, 22 of the past 30 years are also positive returns for the market after you adjust for the impact of inflation. So in summary, what this means is that historically, history shows us that stocks tend to outpace inflation over the long term, which is something I would like to remind to investors who are maybe concerned about today's rising prices and how this could potentially affect them and make it harder for you to reach your financial goals in the future if you don't plan for inflation. Another topic that I wanted to touch on here today that is also in the discussion during our current economic climate is that of a recession. As a reminder, by definition, a recession is a significant, widespread, and prolonged downturn in economic activity. Typically, we've labeled recessions as 2 consecutive quarters of decline in our GDP, and as a result, as a resulting impact, a recession will typically produce economic decline in terms of output, consumer demand, as well as in employment. And as always, various news outlets have jumped all over this idea of an impending recession. But let's remember that they do not necessarily have a crystal ball, and that these, of course, are just predictions that I would argue are made in an attempt to garner more views or more readers. But if we go back to looking at some more history, which you know I love, you can see that over the past century, we've had almost 15 recessions. And in 11 of those instances, the stock market was positive the 2 years after the recession began. Pretty remarkable. So while you may be tempted as an investor to maybe abandon equities or investing in the market and possibly move things to cash, while there's a looming threat of such an economic downturn like a recession, remember that research shows us that most stock prices incorporate expectations of a recession into that underlying value, and the underlying security has again already factored all known information and considerations into the price. So over the past, or overall, the average return in the market 2 years after the onset of a recession was roughly 7.8%. And hopefully, this comforts you, because I completely understand that the idea of a recession or even the talk of a recession can immediately trigger some worry, but hopefully the history and the factual data can aid with your peace of mind. We just have to remember that at the end of the day, as disciplined investors, we need to try our best and not letting economic circumstances, both personally and in our country as a whole, lead us to us making rash or reactive decisions, as this can very much harm us as investors. As we have counseled our many clients many times, sticking with the long-term plan, the long-term strategy, and sticking to our 3 rules or simple rules can help us be prepared for the unexpected things to come. And as a reminder, those 3 rules are to own equities, diversify your assets, and then periodically rebalance your portfolio as needed. And the last chart that I'll show you here demonstrates how sticking to these 3 rules throughout history can reward the disciplined investor, regardless of any economic or cultural turmoil. And you can see here how the growth of a dollar, dated all the way back from 1970 to today, invested in what's called the MSCI World Index. And what I like about this chart is that you can see from the various economic and cultural as well as natural disasters that have happened, how at the end of the day, the market does prevail over time. A disciplined investor should always look beyond the concerns of today to the long-term potential of the market, the long-term growth potential of the market. So when heading into the election season, it's important to remember that the stock market can be volatile in a short-term basis, but it also has a strong track record of long-term success. Since 1980, market corrections have averaged almost 14%, so it can be pretty volatile out there. However, looking at the overall picture each year, the positive years outweigh those negative years, with negative returns only occurring approximately 1 out of every 4 years. Another way to look at that statistic is that since 1980, 33 out of the past 44 years have been positive years in the market, meaning that the market is up almost 70% of the time, 75% of the time rather. So as history has shown, for those who choose to stay the course are rewarded for their patience more often than not. Considering all of the unknown things out there and the uncertainties on what the markets could do come election time, one of the biggest things you should remember is to be patient and not panic. Consider the old saying of time in the market, not timing the market, right? And if you're comfortable with the amount of risk that you currently have in your portfolio, and you do have the time to ride things out, whatever may come, you're more likely to be best to stick with that strategy and again, see what happens and have faith in the long term. On the other hand, if you're maybe within a couple years of retirement, or maybe you have not such a comfortable feeling of the amount of risk you're taking, it may be a good idea to review your financial strategy to make sure that you're comfortable with the outside circumstances and then the risk in your portfolio. And that is what we're here for at Montgomery Financial as your trusted advisors. And if you have any questions, or if you would like to sit down and chat about your own situation, please do not hesitate to reach out. we're more than happy to chat with you. But overall, I hope you have a great day. And again, this was Nick with Montgomery Financial and your quarterly coaching class.